So now let's start with talking about IDEXX Laboratories, an American company. IDEXX is the leading developer and provider of mainly diagnostics products and services for the companion animal veterinary industry, with a market share of close to 50% in the global companion animal diagnostics field. Although IDEXX also has diagnostic solutions for the livestock, poultry and dairy and water testing industries, most of IDEXX revenue, with more than 90% of revenue or profits, comes from the companion animal group, CAG segment. So let's focus on that segment. So IDEXX business in the CAG segment is not complicated. Basically, it provides a fully integrated suite of solutions for the veterinarians to offer advanced vet medical care, from point-of-care diagnostics solutions, including both the hardware testing equipment or analyzer instruments, and the associated testing consumables or rapid assay products, so that the vets can perform in-house diagnostics within their clinics. And then IDEXX also provides IDEXX reference labs solutions, where the vet can send the samples to IDEXX labs for more comprehensive or complicated testing by IDEXX specialized personnel. And IDEXX also have software that helps the clinics and vets run their operations and improve their productivity, like the Practice Information Management System, which is like the ERP system for vet clinics, and is Vet Connect Plus platform, which helps to consolidate all the clinical information of the patients in one place and uses artificial intelligence to suggest takeaways and next steps based on the integrated results. And IDEXX business model is basically to install its various point-of-care instruments, either by selling or renting the various analyzers shown in this slide that are used for chemistry testing, hematology testing to study blood or blood disorders, or urine analysis. And IDEXX sells or rents these analyzers at low margins to the vet clinics. And after those instruments are installed in the clinics, IDEXX will subsequently profit from the recurring sales of testing consumables or kits required to run the test using those instruments, which actually have higher profit margins for IDEXX. As we can see here from the revenue breakdown, the revenue from the sale of instruments, as shown by the yellow shaded bar, is actually quite low. And most of the CAG revenue actually comes from the sale of vet lab consumables and to some extent the rapid assay test products. And then also a lot from the diagnostic services provided by IDEXX's own reference labs in 80 different locations around the world. For these diagnostics revenues, excluding the instrument sales and software revenues, that is the last two bars at the top of each year, IDEXX considers these diagnostics revenues as recurring revenue. So this diagnostics revenue, together with the other recurring revenues like the consumables and rapid assay products, they make up about 80% of IDEXX total revenue now in 2023. So a big portion of IDEXX revenue is high quality because of the recurrence nature. And when we look at the most important screening criteria, ROCE, which is the blue line in this chart, IDEXX has been generating very healthy pre-tax ROCE for many years, which has improved to more than 40% now, including goodwill. Or if we exclude goodwill, then that's close to 50%. With the improvement in ROCE driven by an improvement in operating profit margin rather than capital employed turnover. And that's mainly due to improvement in gross profit margin and some to operating leverage, mainly on G&A. On its ROA is also very high at more than 15%, and now is at 26%. And due to some leverage, its ROE has been very high at more than 55%. And in some of the previous years, its equity amount was actually negative due to its massive share buybacks. Let's examine IDEXX capital employed needs. To grow, IDEXX has to spend more capital on CapEx, like expanding its reference labs and warehouse manufacturing or testing sites, and also incur some net working capital needs in terms of accounts receivables and inventories. Its current high ROCE and earnings level seem to be of high quality and are supported by its switching cost mode, where after installing the hardware instruments and software in the clinics, with all of them integrated and with the vets getting used to using them, there's a high level of switching costs for the vets or clinics to switch to the others, unless IDEXX really screws up on the quality of its services or the effectiveness of its diagnostics or testing solutions. Here we can see that for the majority of IDEXX revenue streams, which is the consumables, the reference lab services, and the rapid assay products, they all have high and also improving revenue retention rates in the US of slightly less than 100%. This means that even if IDEXX doesn't acquire new customers, based on these revenue retention rates, it is likely able to support its current level of revenues or earnings broadly, and the associated high ROCE. Now, if we look at the number of active installed base for the different instruments provided by IDEXX, for its chemistry analyzers, for hematology analyzers, or for urine analyzers, they have been growing well. And the higher installed base will lead to a higher level of recurring consumable sales for IDEXX, assuming the utilization rate of the instruments remains the same or similar. And in terms of percentage growth rate, the total active installed base, excluding the older models, as shown by the light blue line here, has been growing at about 10% to 20% each year since 2017 to 2023. And this growth in installed base, together with the high customer retention rate, help to contribute to IDEXX revenue growth at a CAGR of about 9.5% from year 2009 to year 2023, and with its gross profit and EBIT growing faster at a CAGR of about 11% and 14% respectively. In terms of profitability, IDEXX also earns high and rising profitability, with its latest gross profit margin at about 60%, the blue line, and then operating profit margin at about 30%, the light blue line, and net profit margin at about 23%. So one good thing about IDEXX business model is that IDEXX solutions help the clinics to win and grow better. For example, when the clinics use their practice management information system, the clinics become more effective and efficient in their workflow, improving their productivity, which in turn improves their revenues and profits. And when the vets use IDEXX innovative diagnostic hardware instruments and consumables to do the diagnostic tests, with the results from different tests automatically centralized in IDEXX central platform on the web or on the mobile, and also analyzed automatically using AI, the vets actually become more efficient and achieve more accurate or comprehensive results compared to if the vets perform some of the tests manually. And with a higher test productivity and less time spent on administrative tasks of recording and interpreting results, etc., the vets can see more patients and perform more diagnostics every day, which lead to higher instrument utilization and consumable sales for IDEXX. So IDEXX solutions help the clinics and vets to increase their productivity and revenue potentials. And when that happens, IDEXX also gets to profit from more revenue and lifetime values from these clinics. So far, it seems like IDEXX is a strong company in terms of its operational business. But we also have to see whether we as shareholders will be able to realize the value of the business as a shareholder over a long period of time in the future. So we need to examine the capital allocation of the company and also the longevity and tailwind of the business. On the capital allocation front, IDEXX has been reinvesting moderately, spending about 30% of its operating cash flows, mainly on CapEx and some on acquisitions of assets or companies in similar or complementary fields. And then returning a lot of capital back to the shareholders through massive share buybacks at 86% of its operating cash flows, with no dividend distribution. The returning of excess cash is good. However, as IDEXX shares have always been trading at high PE multiples, the company has been doing those share repurchases at high multiples of between 21 times to 67 times PE multiples. Even when the share was trading at roughly more than 40 times multiples since 2016, the company was still spending very significant percentage of its operating cash flows on buybacks, where arguably the capital return might have been better done through a distribution of dividends if and when its shares are trading at high prices. However, in the AGM this year in mid-2024, when asked about the approach to return capital to shareholders, the management said that they would continue to return capital through share buybacks instead of dividends, without giving any specific logical reasons, other than saying that share buyback is something that the company has been able to do very effectively over time. For the remaining points of this video, you can check them out at our multi-bagger research series. At MoneyWise Smart, we do deep dive research into wonderful companies to own for the long term. We have provided some of this research for free in our free research series, so definitely check them out at the link provided if you want to invest in good companies. I promise you will really benefit a lot from this research. If you have enjoyed this video, do hit the like button now, and don't forget to subscribe and hit the notification bell so that you'll be notified of our future videos. Do also join our Facebook group where we discuss interesting investment concepts and businesses. Thank you for watching, and see you in our next video.